Hello, fellow real estate nerd. Thank you for joining me on this wonderful weekend, or whatever date it is for you. We got some numbers to talk about. It is that first video of the month where we go through all the Northwest MLS data. So if you like graphs and looking at data, well, you're in the right spot. So let's go look at what's been happening in Gig Harbor as our market has begun to slow down, as my thumbnail indicates. But let's look at the numbers really and see and digest some of this data, and then talk about some of my thoughts at the end of the video about what we can expect to see, what are some possibilities and probabilities of what can happen to the market. So without further ado, let's get into the numbers and crunch them. Okay, let's start looking at some numbers. Pulled up here is what's happening in the entire Northwest MLS or the Puget Sound area. You can see that, I don't know if it's visible on your screen, our current MLS median sales price for residential previously owned is $625,000. And you can see it's starting to kind of roll over here. So we can just compare that to what's happening in Gig Harbor. Let's make sure that we have all the rolling through. So, you know, kind of similar. This is 3-month rolling data, but monthly is a little bit too much noise involved. We don't have enough inventory to be smooth like that on the monthly. Anyway, I digress. Here we see Gig Harbor's numbers. We're slightly down from last month. We dropped $5,000. That's not much, and so we're sitting at $770,000 per median sales price in Gig Harbor. So that's what we're looking at. And now people have been kind of confounded by the fact that interest rates are so high, but housing prices haven't quite come down to reflect the high interest rates. I mean, housing costs like doubled essentially, or even more than that. And it's like, well, how come the housing prices haven't dropped? Well, that's because of interest rates. And 2 years ago, a lot of people bought with very low interest rates, and now they're just sitting pretty, or maybe they're miserable, who knows, but they're essentially trapped, or they're just hunkered down in their homes, and they don't want to, you know, sell their home and then go into essentially a home that costs twice as much, which is pretty much the same. So they don't want to double their housing prices for the same house. So they're saying, well, I'm just going to stay put and wait for interest rates to come down again, which means that they're going to be stuck in their house for a long time. So that's just what's happened. The people don't want to move because of the interest rates and just the fact that things have gotten expensive. And, you know, if you have like a 3% interest rate, I mean, you're doing better than inflation. So, and there's no reason to sell your house. So this has caused a real lack of inventory. And this lack of inventory, coupled with the fact that, well, demand is also down because of interest rates being high. So demand and supply have really just gone down neck and neck, and they've kept pace with each other. So that's just led to a stabilization. Because if demand was, you know, sky high, prices would go up, and if inventory was sky high, you know, prices would come down. So the fact that they're both just neck and neck just means that, you know, houses have stabilized in price, even though that interest rates are so high. Anyway, that's what it is. So with that said, let's look at new listings, because that's really what's been going in, you know, of interest to me recently. And let's look at that. Let's pull this into a monthly data, because the 3-month rolling, as I talked before, is kind of skewed. So August, 77 new listings. July, 77 new listings. So both months have had relatively low listings. And as you can see, where we are prior years, 110 new listings. Here, August, 123 new listings. August, 107 new listings. August, 113 new listings. So we're doing pretty poor in terms of new listings. And of course, that's indicative of where we are right now. And, you know, it just means that buyers really have very little to choose from. We're getting less than 20 houses per week on average hitting the market. So that's, considering the size of Gig Harbor, that's not a lot of houses every week. So this is where we are. This market's cooling down, and as you see, that these are pretty seasonal patterns. So after August, man, it's just, you know, down to the trough here that we usually see in December or January. So, well, December. So December is the trough. So, you know, it's down until December, and then hopefully we'll come back up with a reasonable amount of inventory after the slow winter season. So that's what we have there. Now, pending sales, closed sales, days on market. Days on market slightly up from 11 of July to now 13 in August, so 13 days on market, so just under 2 weeks. It's not bad. I think people got spoiled during the COVID times when houses were selling during the weekend, and now we're 2 weeks. It's not too bad, but it's also indicative of the fact that just the buyer pool has been shrinking as interest rates do go up, and just seasonal trends means that the buyer pool shrinks as people just want to stay put and kind of just stay in school during the school year and don't want to pull their kids out in the middle of the school year. And not too much. It's like we don't have any precipitous drops or skyrocketing days on market. Like what happened here was the interest rates just were chaotic, and everybody was like, "Oh my God, look at the Fed just hiking rates," and loan officers couldn't figure out what rate to give people getting mortgages. So we've kind of just 2 weeks. That's fine, but I expect it to continue to slowly go upwards as we do enter the slower season. Buyers continue to drop out. Interest rates do remain stubbornly high, so I can imagine this continues to go up. Now let's talk about month's supply of pending, otherwise known as inventory. So basically, how many months of inventory we have, or how many houses are on the market at the moment with the current demand. And so here it says in August, we have 1.9 months of inventory. So if not a single house goes on the market starting today, it would take a little under 2 months to sell all the houses currently on the market in Gig Harbor. So that might seem like a lot. Let's see, monthly, it's the 3 month. So the 3 month shows that we are up to, that's a alarm. From 1.9 to 2 months of inventory. That's where we were last year in September. Now the difference is we don't have the interest rates fluctuating as much as they did last year. And so that's, you can see what happened in the inventory even during the crazy interest rate hikes. Now we're sitting at the same amount, and it's not, so inventory means how many houses there are on the market, and it's not like we've got a surge of new houses. As we just saw, the new listings are dropping, and for some reason our inventory, where'd it go, is going up. So what's happening? What's happening is buyers are dropping out, so the houses just are staying on the market, and the houses are kind of accumulating, and people just aren't showing up to buy them. So that's what's going on. So I can see inventory continue to go up or kind of stabilize just as buyers can drop out and people, less houses get listed during the winter months. So it might just continue to kind of hover around that mark. So that's just something to pay attention to. So finally, we're going to look at shows per listing. This is basically looking at foot traffic. What's been going on, the amount of people looking at each listing before it gets sold. So from July to August, we dropped by 0.4 showings. So, not even half a person or half a party. But we'll go from 7 to 6.6, and that's just a slow grind down, I think, as we enter the slow season and the buyers continue again just to kind of get whittled down by the interest rates being so high, and the seasonal effects of buyers dropping out and interest rates. So this might just continue to grind down, especially as there will be fewer and fewer listings coming on. So which means, if there's fewer listings, it means each one will get visited more than if there were a lot of listings. So this might just kind of peter out, I think. I don't think anything will drastically happen to this figure. Okay, now with that being said, what does this mean? It just means that we're slower than last month, and last month was pretty slow, and this just means people with cash are in a good position to buy. They will continue to have less and less competition from people who are getting mortgages, so that's good news if you're a cash buyer. And if you're a seller, well, you can still price your house aggressively and get it sold. We see a couple houses doing that probably each week, and they do go pending rather quickly, just because people are looking for still a good buy. So if we can, if an agent can convince you that it's good to price your house lower than you want, but that'll also get your house sold quicker and probably have competition still on your house, you should listen to that. And hopefully the agent is me. Anyway, some ending thoughts here that I included. So let me just read it here. Many people, including economists, are expecting interest rates to come down. However, they expect this to happen in terms of quarters rather than years. While I have speculated that our current inflation cycle is akin to that of the 1940s, with whiplash-induced inflation, it is possible that the Fed will simply continue to keep their finger on the high interest rate button like they did during the years 1972 between the years 1972 and 1993. So that's for 21 years, interest rates on a 30-year fixed mortgage remained above 7.5%. So for over 2 decades, interest rates were essentially where they were now. So take that for perspective of what the Fed can really do and how stubborn the Fed can be when it comes to their monetary policy. So it is also likely that interest rates will continue to rise as the Fed continues to navigate by the stars on a cloudy night. That's what Jay Powell said during the last Fed meeting at Jackson Hole, which is basically the Fed doesn't quite know what they're doing and they're just kind of kicking the can kind of slowly down the road. And the risk premium continues to increase thanks to the economic correction that's currently happening in China. So I talked about the risk premium and how that impacts the 30-year mortgage rates, was it last week or the week prior? But I did explain what the risk premium is. And next week I will talk about what's happening in China. That's something to pay attention to because what happens in China essentially impacts the entire world's economy. And if you are attached to the world's economy, then it'll impact you. So we'll talk about that next week. But let me just show you, just because I can. Let's just go to Google. Let's type in year. There we go. So this is what happened during the 1970s. So here we have 1972. So we crossed 7.5% here in April of 1972, and we are just above that for the longest time, all the way to July 1993. And even then it goes back up. You don't even see me. Okay, so I'm talking to myself. That remains rather high here, until the really 2000. And not until 2000 do we actually get below 7.5%, for a reasonable duration. So all these like little short spikes below 7.5% weren't, for that long really. So that's just kind of putting it in perspective just how long the Fed can just keep rates high and not really be worried about what economists think will happen just in a few quarters down the road. I mean, this can be a protracted event here. Don't get your hopes up in terms of waiting to buy a house next year. I think it's going to be a long time before interest rates come down to where they were, in the late in the 2010-2020 region. So that just means that the real estate market will continue to shift to renters, and it's just going to be tricky to buy a house. I think the thing that'll have to happen for affordability to go up is that wages are going to have to adjust to what's going on. So I don't think anything is going to happen in terms of interest rates to make things affordable. I think wages and just everything has to catch up to what's happened recently. Oh, and I just realized that my video was off. Anyway, those are my thoughts. Thank you for watching, and we'll talk about China next week. And that's the latest news you can use, and hopefully that can help you out somewhat as you consider real estate in Gig Harbor. So catch you next week.